Hi, this is Joe Serta, President of NAIFA-Indiana, welcoming you to the November edition of NAIFA-Indiana This Month, your video newsletter. Your trustees are hard at work transitioning your new leadership team so they'll be able to hit the ground running in January. But we still had time for a little fun. Last month, Women in Financial Services had their national meeting in Indianapolis. NAIFA National held a happy hour and invited leaders from NAIFA-Indiana. Rock Plank, Chris Barnhouse, and I attended. What a great event. There were snacks and activities from bowling to cornhole. And to top it off, we got to spend time interacting with key leaders from NAIFA National and Women in Financial Services from around the country. Women are so important to our industry, and NAIFA-Indiana is now exploring ways to start a chapter of Women in Financial Services in Indiana to help capture some of the energy, excitement, and great ideas we experience at their national convention. November brings falling leaves, colder weather, and the thoughts of Thanksgiving for a bountiful harvest. Here with a special Thanksgiving message for our members is Indiana Insurance Commissioner Amy Beard.
Thanksgiving is right around the corner. It's that time of year where we take a look back over the past year and reflect. I am so grateful for the opportunity I have to lead such a strong team as the Commissioner of the Department of Insurance in Indiana. The past few months have been a whirlwind as I've transitioned into my new role, and I'm so thankful for the support that you all have shown me. I've been fortunate to have the opportunity to speak with so many knowledgeable and interesting people like you all in the insurance industry. The work that you do for NAIFA-Indiana members can make a tremendously positive impact on the lives of your clients, often at times where people need to have financial protection during a critical life event, such as a health emergency. At the IDOI, an important part of our mission is to protect consumers as they purchase and use insurance products to keep their assets and their families from loss or harm. We have a fantastic team to work with at the IDOI who live out that mission every year. For example, in the past year, the IDOI Consumer Protection Unit has been able to recover over $7.3 million for consumers via the consumer complaint process. Our team was also able to recently implement the carryover provision to benefit insurance producers. During the 2021 legislative session, Indiana passed Public Law 196, which allows an insurance producer who completes more than 24 hours of continuing education credits before the producer's license renewal date to carry over those credit hours and apply these hours to the producer's next license renewal period. This carryover is limited to no more than 12 credit hours. And the IDOI implemented the carryover provision with CIRCON, and it is now fully functional. Our team's other primary obligation is to monitor the financial solvency of the insurance companies domiciled in Indiana so that the legal promises made in insurance policies are honored. I'm proud of the hard work that our team members who have assisted those companies in need as well. We have 18 new companies that have obtained a license to write insurance in Indiana, and 24 insurance companies expanded, adding 36 more lines of insurance business. The opportunity to be a public servant in the state of Indiana gives me great joy every day of the year. And thank you for the opportunity to speak. And I wish you all a happy holiday season and a healthy and prosperous new year.
Thank you, Commissioner Beard, for taking the time to share your thoughts with our members and for your great work making Indiana a better place. I think I can speak for all members of NAIFA-Indiana when I say we look forward to working with you now and in the future. On November 11th, the nation pauses to thank the millions of veterans who at great personal risk left their homes and families to serve in the nation's armed forces. It is only because of their service and sacrifice that we have the freedom to offer our clients the products and services so vital to their financial well-being. As a first-generation American, I am ever mindful that my family would not have the freedom and prosperity we now enjoy in any other country. America is truly the land of the free only because it is also the home of the brave. Please join me in a Veterans Day salute to those NAIFA members and their family members who have served in the nation's armed forces. For our monthly sales tip, I am joined by Trustee Rock Plank of Fairway Mortgage. Rock, what do you have for us today?
Well, Joe, thank you. The tip for this month would be to remember to use home equity. Across the country, we're using or talking to financial advisors about home equity and how that can be used in the financial process. We have a lot of financial advisors that are now incorporating the use of home equity and reverse mortgages in their Roth conversion strategies. We're also talking to advisors and their clients about how they can use home equity for healthcare. So that would be the tip of the month, is to remember to use home equity.
Rock, that was a great tip. I think I'm going to use that myself. By the way, Rock, we were just talking about Veterans Day. I understand Fairway is a big supporter of veterans.
So at Fairway Independent Mortgage, we are strong veteran advocates. And in fact, we've got a not-for-profit that we support, the American Warrior Initiative, in which we use that initiative to help provide service dogs for deserving veterans across the country. If you were to go into any Fairway office on a Friday, for instance, you're going to see what we call the red shirt. The red shirt stands for Remembering Everyone Deployed. Our company underwrites the nonprofit American Warrior Initiative, all the operational costs. And so when individuals buy these shirts, those funds go to purchase service dogs for deserving veterans, provide financial grants to support those dogs, and even in some cases, businesses. So we are very proud supporters of veterans. In fact, we are the leading veteran purchase lender across the country. So veterans are a strong commitment for us, and we're happy to be supportive of such things.
Wow, Rock, I had no idea. You and your company obviously do this from the heart, not for the publicity. That's impressive.
Correct. If you were to look at any of our red shirts that we now see being worn, not just by our employees, but our referral partners, our customers, you will not see Fairway's name on any of that. The goal is not to market Fairway, it is to support the veterans and to give back to the communities and to thank those that have served us so valiantly.
Rock, thanks for what you do, and thank you for joining us at NAIFA, Indiana.
Thank you, Joe, for having me.
November is both Long-Term Care Awareness Month and Veterans Day. To combine the two, we are now joined by trustee-elect and long-term care insurance expert Chris Barnhouse, who is himself a veteran of more than 25 years of military service. Chris, welcome to NAIFA, Indiana.
It's a pleasure to be here, Joe.
So Chris, how do you combine Veterans Day with Long-Term Care Awareness Month?
Well, I thought we might tell our members about long-term care benefits for veterans. I think they'll discover that benefits are far different than is commonly understood. How many of you have heard this one? I'm a veteran, the VA will pay for my care. Most veterans truly believe that when they say it. Unfortunately, it's not generally true. The VA does not provide long-term care to veterans or military retirees except under some very narrow circumstances. Unfortunately, most veterans and advisors don't understand what the VA will and will not provide. I'm going to take this time to clear up those misconceptions. Now, I'm going to simplify this a great deal. The VA eligibility criteria are many and complex. It's almost like the tax code. For more complete information on specific cases, you'll need to go to the VA website or get help from a veteran service organization like the American Legion, the VFW, or Vietnam Veterans of America. This is what the VA program is. The program is primarily for those with severe service-related illnesses under their priority group system. Payment for custodial care is generally reserved for those whose injuries require custodial care. Really, the primary address for long-term care for veterans and military retirees is through the Federal Long-Term Care Insurance Program, which is a group long-term care program managed by the federal government. For VA nursing home, the Veterans Administration will pay for nursing home for only veterans with 100% service-connected disability or 70% service-connected disability and who are homebound. The federal government intends for military personnel to sign up for the federal long-term care insurance program while they are on active duty or even post-retirement in order to address that issue. And a lot of veterans think about the Indiana Veterans Home in West Lafayette. It's a very fine facility for veterans only, but it is not free. It is private pay until the veteran runs completely out of money, then he or she goes on Medicaid. And it's really fairly pricey. So don't plan on the Indiana Veterans Home being free unless you go on Medicaid. And of course, Medicaid will cost you everything you own. There's a lot of talk about the aid and attendance benefit. and that is designed to ensure wartime veterans and their widows don't end up on the street. It provides a small home health care benefit that is means tested. And again, it is only for wartime veterans, spouses, and widows. And there are specific times, if you go to the VA website, it will give the specific service dates that the veteran has to have been on active duty for at least 90 days, and at least one of those dates has to be during a time of war. But many people think you can get it whenever you ask for it, but it is means tested. Veterans are limited to a net worth of $130,773, not including their home, as of December 1st, 2020, in order to be eligible. And countable income is deducted from the eligible benefit. Again, these 90 days of active duty with at least one day during a period of war, and those periods are listed on the VA website. You have to have a discharge of other than dishonorable. The surviving spouse must have been married to the veteran at the time of his passing and has not remarried. They must require assistance from another person to perform activities of daily living, and they must meet income and countable asset criteria established by the VA. So you just don't walk in and ask for it. They must be 65 years or older, or be totally disabled. The likelihood of having the Veterans Administration pay for non-service connected disabilities is slim to none. The surviving spouse of a veteran can receive a monthly benefit of $1,244, and that's the maximum for aid and attendance. Veteran with no spouse or dependent children, $1,936. And a married couple where the veteran requires care, $2,295. And if the veteran is healthy but the spouse requires care, veteran qualifies for income improvement pension, which is what this is actually called, a $1,520. And this is just a few examples of the pensions that are available. But the aid and attendance benefit is limited by income and the maximum annual pension rate. And that's called the MAPR because it really wouldn't count as a federal program if it didn't have an acronym. And the pension is reduced by the countable income. So the actual pension they would get is the MAPR minus whatever the countable income is. For example, a veteran with no dependents who qualifies for the aid and attendance benefit would qualify for $23,238 per year. A veteran with at least one dependent who qualifies for aid and attendance benefits would be $27,000, and a married veteran where both are veterans and they qualify for aid and attendance benefits would be eligible for $36,861. But let's say we had the qualified veteran with a dependent non-veteran spouse, no children, and the veteran qualifies for the aid and attendance benefit, and they have a combined income of $10,000 per year. Their MAPR amount for that qualification is $27,549, but the yearly income is deducted from the MAPR amount, so the actual aid and attendance pension would be $17,549 per year, or $1,462 per month. And veterans' incomes are added to their net worth when determining eligibility. For example, a veteran has a net worth of $121,000, an annual income of $14,000. When the VA determines his or her eligibility for the aid and attendance benefit, they would add the $14,000 in annual income to the $120,000 in net worth and come up with a total of $135,000, which would mean that that's more than $130,773, so the veteran would not receive veterans' pension benefits. So what do you do in that situation? Well, you can encourage the veteran or their family to put some of their money into an immediate annuity, which will generate income for themselves or somebody else in order to get down to that net worth limit. That is appropriate when the veteran is fairly close to the net worth limit. The problem we have is there are some they're either ignorant or unscrupulous, and they will go out and tell somebody with a very large net worth that they should put that all into an immediate non-refund annuity so that they can get down to that minimal benefit level and receive the benefit. I've had that happen in my family. When my mother entered assisted living, somebody showed up at her assisted living facility and tried to talk my brother into having her take $750,000 and put it into a non-refund immediate annuity so she could qualify for about a $1,400 a month benefit. And my brother was all in favor of it, and I explained to him, this is not going to work. She's going to get $1,400 a month, and that's great, but she's got to give up all of her assets, And what happens if he needs a nursing home? How are we going to pay for that then? And he thought about it, so we decided not to do it. And when my mother passed away, 3 months later, she had a fairly significant estate, which she would not have had we listened to as my brother said, well, the salesman said, and I said, the operant term here is salesman. So I would encourage our members to help veterans if they are somewhere near the level to where they can get down to receive those benefits, but not to have them exhaust all of their assets just to get down to that small benefit. Bottom line here is the VA benefits are designed to provide nursing care for severely disabled veterans and to provide some assistance for wartime veterans and their widows who are of modest means. The proper term is modest means. The whole idea was to keep veterans and their widows who were disabled from being thrown out on the street or not receive the necessary care. They are not a substitute for responsible long-term care and retirement planning. Now that said, it doesn't mean if you've come across somebody who is going to be eligible for these benefits, you can't do anything for them. I had an experience a couple of years ago where Andre Brogard of Jeffersonville, one of our longtime members, introduced me to a couple who were trying to figure out what their long-term care benefits should be or how they design a long-term care program for themselves. Husband was 100% service-connected disabled, so he would get his nursing home paid for by the Veterans Administration. So what we did was we put him into a very cost-effective home health care only policy so he could stay home longer because the VA was not going to pay for home health care, and his wife got an affordable traditional long-term care insurance policy. So you can still help the veteran, just be aware of what the benefits are and what they're going to be eligible for. For more complete information, contact the Veterans Administration at va.gov.
Thank you, Chris. That's very illuminating. Now I understand you're marking Long-Term Care Awareness Month by teaching continuing education classes on the topic.
That's right, Joe. Our NAIFA-Indiana affiliate in Salamone has asked me to teach the 5-hour long-term care insurance renewal CE at Charlie Creek Inn, 111 West Market Street, Wabash, 46992, 9 a.m. to 2 p.m. November 17th. Lunch will be provided. Contact Sandy Gray to reserve a spot. And on November 18th, I'll wind up the 4-hour NAIFA-Indiana CE meeting with an update on the long-term care insurance market in Indiana.
Wow, Chris, you have quite a month planned. Thank you for your service to NAIFA-Indiana and the country.
No need to thank me, Joe. It was a pleasure and a privilege on both parts.
As the year comes to a close, insurance companies are scrambling to redesign their products to comply with Regulation 7702. Here to shed a bit of light on the subject is Sam Roque, Senior Vice President of Protection for Ash Brokerage. Mr. Roque, we're hearing a lot about Regulation 7702. What can you tell us about it?
IRS Code Section 7702 is the section in the tax code that governs and defines what is a life insurance policy. And it also defines what is a modified endowment contract and what is not. When this was all sort of initially codified, if you will, in the 80s, this was built in with sort of hard-coded interest rates, and the hard-coded interest rate back then was 4% for a lot of the calculations. And there's a lot of minutia as to how you calculate what's a life insurance policy, how you calculate what is a modified endowment contract, but it all ties back to an interest rate and a life expectancy. And because it's connected to those two things, the interest rate has a significant impact on the outcome. It was hard-coded at 4% in an era where rates were 8, 10, 12%, and it wasn't really contemplated that we could be in a prolonged low interest rate environment. Fast forward to 2020, we're in a period of time where the 10-year Treasury had dipped below 1%, and briefly even the 30-year Treasury had dipped below 1%. And legislators and insurance companies realized that 4% interest rate was outdated. And because they'd realized it was outdated, that was causing problems for a number of insurance companies, particularly whole life companies. If you paid close enough attention, you'd realize that some insurance companies were having a hard time pricing like a 10-pay whole life product. And it was almost entirely because of the nuance to 7702 that I've been discussing. And so you saw Mass Mutual come out with a 12-pay product because they were having a hard time pricing their 10-pay product without triggering modified endowment contract status. So at the end of 2020, very, very quietly, insurance companies got legislators to very briefly and discreetly open up 7702. Now, nobody in the industry wants legislators to look particularly carefully at 7702 because no one wants to adjust the tax benefits of life insurance, right? We enjoy tax deferred growth. We enjoy withdrawal of cost basis on a tax-free basis, as well as borrowing against gains and a tax-free death benefit. So nobody really wants to adjust that, but legislators and insurance companies realized that we had a problem. And so what they did was they went in and they changed that interest rate. And really that was pretty much all that they changed. And they essentially make the rate float now, but they tie it to a more relevant interest rate benchmark. That's a really long-winded explanation of basically saying that now, after the changes to 7702, which pretty much every insurance company, save for a few, have adjusted their products to fit within this new construct. The long and short of it is you can now put in more premium into a life insurance policy without triggering modified endowment contract status or jeopardizing the definition of life insurance test, neither of which are things that you want to mess with typically. Off the cuff, that sounds kind of bad, right? More premium into your policy. For a lot of reasons, that's actually a good thing if you want to accumulate a lot of cash value in your policy and take advantage of the tax deferral and tax-free nature on the back end of the policy proceeds. So functionally, what you get is more efficient cash accumulation vehicles. That's the net result of the changes to 7702. And it comes at a really interesting time where legislators are strongly contemplating increasing marginal tax rates, increasing tax rates on long-term capital gains and qualified dividends, adding a surtax to those in the highest income tax bracket. So it comes at a really interesting point in time and a really relevant point in time. So the intersection between tax changes and the changes to 7702 has been a really interesting time, and we've therefore seen a really significant uptick in that type of business.
What changes do you see in the life insurance industry as we enter 2022?
Well, so a lot of the changes have happened already. So pretty much every insurance company has adjusted their internal tests inside policies that define what is a MEC and what is a life insurance policy. So those things have already sort of been baked in. Contracts have already gotten more sort of cost efficient, so to speak. And so the first of the year won't necessarily mean any dramatic difference other than this. And this will be a little bit of a challenge kind of moving year to year, is because the interest rate floats, the test will in theory be calculated slightly differently next year. And so, that minimum non-MEC death benefit, if it was $1 million in 2020, might be $1,050,000 in 2021. Now, one important sort of nuance to understand here is that once you put a contract in place, the 7702 calculations are good throughout the life of the contract. It does not change that contract. You're essentially locking it in. So the change that would happen between 2020 and 2021 would really only be relevant for contracts that are issued in 2021. So I don't anticipate any significant differences. Rates haven't really changed that much in the last year. That could change between now and the end of the year. And there's a lot of interesting things going on in our economic environment, but that could change year to year. But you also should know that once you lock it in the contract, it is locked in through the life of the policy.
That is very good information. Is there anything you'd like to add?
The only thing I would add is that it's just a really interesting time to be considering this. We're going to find out here in the next few days, at the next few weeks, whether or not there's a new bill with increased taxes in it. And ultimately, that'll be relevant for a long period of time. But ultimately, the will of the people seems to be increased taxes among the wealthy. And you kind of have to look at where we've been, as well as sort of where we're going in terms of where tax rates might be, not just for the next year, but for the next 5, 10, 15 years. And so we're going to see a really significant uptick in the value of financial advice and the value of financial planning. Advisors that do planning from a tax perspective are going to be really well positioned for the future. The value of financial advice is going to be significant. Very few of these changes are what you would call simple. And so the forecast for complexity is high, and individuals, families, businesses, they need good guidance as to how they plan for the future.
Thanks for sharing your knowledge with us, Mr. Roque. That's not only great information, but a good reason for advisors to be members of NAIFA. This concludes our November edition of NAIFA-Indiana this month. Don't forget our upcoming events. The November 17th 5-hour renewal CE being taught by Chris Barnhouse at the Charlie Creek Inn in Wabash. The November 18th half-day CE meeting, which will be available in person at Connor Prairie's Overlook Room, 13400 Allisonville Road in Fishers. Starting at 8:30, topics will include ABLE account, how individuals with disabilities can save money and not risk losing their benefits, by Amy Corbin. Immediate Results Workshop with David Linsmeyer. Communicating with Clients with Dementia by Hadia Sow. And a Long-Term Care Insurance Market Update by Chris Barnhouse. As we enter the holiday season, I am personally thankful for each and every member of NAIFA Indiana. Together, we can take on anything.